Material misstatement refers to errors or omissions in financial statements. These inaccuracies are significant enough to mislead users. In simpler words, it's like forgetting to include a big expense in your budget. This makes your budget look much better than it actually is. This omission is a problem because it gives a false impression of your finances. Material misstatements can be intentional, like fraud, or unintentional, like errors. They can relate to various aspects of financial reporting. This includes revenue recognition, asset valuation, and liability disclosure. The concept of materiality is central to auditing. Auditors focus on identifying and assessing risks of material misstatement. Understanding material misstatement is crucial for stakeholders. Investors, creditors, and regulators rely on accurate financial information. Material misstatements can distort their decision-making. This leads to financial losses and erosion of trust in the market. Therefore, auditors play a vital role in ensuring the reliability of financial reporting. Materiality is a fundamental concept in auditing. It helps auditors make important decisions throughout the audit process. Auditors use this concept to determine the nature, timing, and extent of audit procedures. They need to decide which areas of the financial statements require more attention. Materiality acts as a guide for them. Auditors consider materiality in the planning phase of the audit. They set a materiality level for the financial statements as a whole. This level reflects the amount of misstatement that would be significant to users. It helps them determine the overall audit strategy. Auditors also use materiality to evaluate the results of audit procedures. They compare any misstatements they find to the materiality level. If a misstatement exceeds this level, it is considered material. The auditor will then ask management to correct it. If management refuses, the auditor may issue a qualified audit opinion. The risk of material misstatement is the likelihood that financial statements contain material errors. This risk is inherent in the preparation of financial statements. It arises from factors like complex transactions, weak internal controls, and management bias. Auditors must carefully assess and address this risk to provide reasonable assurance on the accuracy of the financial statements. There are two main categories of risks of material misstatement: inherent risk and control risk. Inherent risk is the susceptibility of an account balance or class of transactions to material misstatement. This is assuming there are no related internal controls. For example, cash is considered to have a higher inherent risk than inventory. This is because cash is more susceptible to theft. Control risk is the risk that a material misstatement could occur in an account balance or class of transactions. This misstatement could be material, either individually or when aggregated with other misstatements. It will not be prevented, detected, and corrected on a timely basis by the entity's internal control. For example, if a company has weak internal controls over its cash disbursements, there is a higher risk that fraudulent payments could be made. Material misstatement, audit risk, and detection risk are interconnected concepts. They form the foundation of an auditor's risk assessment. Audit risk is the overall risk that the auditor may fail to detect a material misstatement in the financial statements. It is the risk that the auditor will issue an unqualified opinion on financial statements that are materially misstated. Detection risk, on the other hand, is the risk that the auditor's procedures will not detect a misstatement that exists. This risk is influenced by the effectiveness of the auditor's procedures and their application. It is also affected by the auditor's judgment in designing and performing those procedures. The relationship between these risks can be expressed mathematically as follows. Audit risk equals inherent risk multiplied by control risk multiplied by detection risk. This formula highlights the inverse relationship between detection risk and the combination of inherent risk and control risk. As inherent and control risks increase, the auditor must decrease detection risk to maintain an acceptable level of audit risk. Section 5. Deconstructing inherent risk factors at play. Inherent risk is influenced by, a multitude of factors, both internal and external, to the entity being audited. Understanding these factors is crucial for auditors to effectively assess the susceptibility of financial statements to material misstatement. One key factor is the nature of the entity's business. Companies operating in volatile industries such as technology or energy often face higher inherent risk. This is due to the rapid pace of change and uncertainty surrounding future prospects. Complex or unusual transactions, such as those involving related parties or intricate financial instruments, also increase inherent risk. The overall economic climate and industry-specific conditions play a significant role in shaping inherent risk. Economic downturns or increased competition can pressure management to manipulate financial results. Similarly, changing regulatory landscapes or accounting standards introduce complexities that heighten the risk of misstatements. Section 6. Unpacking control. Risk factors influencing its assessment. Control risk, the risk that internal controls fail to prevent or detect material misstatements, is influenced by the design and effectiveness of an entity's internal control system. Auditors evaluate the control environment, risk assessment process, control activities, information system, and monitoring activities to gauge control risk. A strong control environment characterized by ethical values, competent personnel, and a commitment to integrity reduces control risk. Conversely, weak controls, such as inadequate segregation of duties or lack of independent checks, increase the likelihood of errors or fraud going undetected. The effectiveness of control activities, such as authorization, reconciliation, and physical safeguards, directly impacts control risk. Properly designed and implemented controls can mitigate the risk of material misstatements. However, ineffective controls or those bypassed by management provide little assurance. Section 7. Preliminary analytical procedures and brainstorming. Early detection of high-risk areas. Preliminary analytical procedures and brainstorming are crucial steps in the audit risk assessment process. They enable auditors to identify areas of heightened risk early on, allowing them to tailor audit procedures accordingly. Preliminary analytical procedures involve analyzing financial and non-financial data to identify unusual fluctuations, trends, or relationships that warrant further investigation. This might include comparing current year data to prior periods, industry averages, or budgeted amounts. Brainstorming sessions bring together the engagement team to share their knowledge of the entity, its industry, and potential fraud risks. This collaborative effort fosters a deeper understanding of the entity's operations and helps identify areas where fraud or errors are more likely to occur. Section 8. Navigating the waters of detection risk and audit risk. After assessing inherent risk and control risk, auditors determine the appropriate level of detection risk to achieve the desired level of audit risk. This involves considering the overall risk of material misstatement and the effectiveness of planned audit procedures. If inherent and control risks are assessed as high, the auditor must set a lower detection risk to compensate. This means performing more extensive substantive procedures to obtain sufficient appropriate audit evidence. Conversely, if inherent and control risks are low, the auditor can accept a higher detection risk and perform less extensive procedures. The determination of detection risk directly influences the nature, timing, and extent of audit procedures. A lower detection risk necessitates more rigorous testing, such as larger sample sizes, more reliable sources of evidence, and greater emphasis on unpredictability. Section 9. Responding to the challenge, tailoring audit procedures to address material misstatement risks. Once auditors have assessed the risks of material misstatement, they design and perform audit procedures to address those risks. This involves tailoring procedures to the specific circumstances of the entity and the assessed risks. For areas with high inherent risk or weak internal controls, auditors typically perform more extensive substantive procedures. These procedures are designed to obtain direct evidence about the balances and transactions in the financial statements. This might include confirmation of receivables, inventory observation, or testing of internal controls. Conversely, when inherent and control risks are assessed as low, auditors may rely more on analytical procedures and tests of controls. Analytical procedures involve evaluating financial information through plausible relationships among both financial and non-financial data. Tests of controls are designed to evaluate the effectiveness of internal controls in preventing or detecting material misstatements.